In our last video, we have discussed the business of investment banks and the different types of investment banks. In this video, we will be introducing investment bank divisions. A global investment bank typically has 3 business divisions or business segments, including investment banking division, trading division, and asset management division. The actual business divisions of an investment bank may have some differences, but it can usually be classified into about 3 business scopes. People working in investment banking division are bankers. They help governments, corporations, and institutions raise capital and complete mergers and acquisitions. People working in the trading division include traders, sales, and researchers. They help institutional clients buy and sell securities. They may also trade with their own bank's own account. People working in asset management division include investment managers and private wealth managers. Next, we will take a closer look at these 3 divisions of an investment bank. The investment banking division is responsible for arranging financing for corporations and governments by issuing securities, including equity, debt, and hybrid. They also advise on mergers and acquisitions for corporations. Investment banking division can be broadly split into 2 sectors, a product group and a client coverage group. The product group usually includes a capital market group and a M&A group. Capital market group bankers are financial specialists who help a client raise capital and determine product details, such as funding size, timing, and pricing. Within the capital market group, bankers may work either in debt capital market or equity capital market. Equity capital market or ECM bankers help clients raise funds through issuance of common stocks. Issuance and underwriting of common stocks is one of the oldest businesses of this industry. ECM bankers provide initial public offering or IPO service to firms that are new to the capital markets. They also provide seasoned equity offering or follow-on equity offering services for companies that return to the capital market for additional common stock offerings. In addition, they help major shareholders of a company to sell their large block holdings of a company stock through secondary offering. The bankers may also provide fundraising services to private firms through private placements. In addition to the issuance of common stocks, they help with the issuance of hybrid products, such as convertibles and preferred stocks. They may also engage in equity derivatives, such as options and futures. Debt capital market, DCM, bankers focus principally on debt financings for corporations and governments through the issuance of bonds. Their clients can be grouped into 2 major categories: investment-grade issuers and non-investment-grade issuers. Investment-grade issuers have a high credit rating from at least one of the major credit rating agencies. For example, they need to have a rating of Baa or stronger from Buiness, or a rating of BBB or stronger from Standard & Poor's. Bonds offered by investment-grade issuers are called investment-grade bonds. Bonds offered by non-investment-grade issuers are known as high-yield bonds or junk bonds. The DCM bankers are finance professionals who help arrange details of debt financing by determining timing, maturity, size, covenants, call features, and so on. Our next subgroup of bankers in the product group is the M&A group. This group includes bankers who specialize on mergers and acquisitions. Their clients include companies who want to buy another company, as well as companies who want to sell part of their business or the entire of their business. The M&A group bankers provide buy-side services that involve the purchase of a part or the entire of a company. They also provide sell-side services that involve the disposition of company assets. The bankers also provide services on corporate restructuring events. They also advise on defense strategies for firms facing potential hostile takeovers. In addition to product group bankers, we have another team of bankers working in client coverage group. Client coverage group is less focused on products. The job of client coverage bankers is more related to relationship management of potential clients. The client coverage bankers are either assigned to work in industry teams or geographic teams. Usually, the bankers are assigned to work in an industry-based model. Bankers are required to have profound knowledge in their respective industry. Usually, each banker will be assigned to work with a few companies of their respective industry. The bankers need to maintain close contacts with their assigned companies and understand the business and financing objectives of their clients. Client coverage bankers are responsible for knowing the needs of their clients and sell investment banking products to their assigned clients. For example, the CEO of a firm may want to enhance their focus of their core business. A client coverage banker may introduce corporate restructuring services to that CEO. Another CEO may want to raise funds and expand its business overseas. The client coverage banker, knowing the need of the CEO, will work with product group to help that CEO with the expansion. This may lead to stock issuance, bond issuance, and M&A transactions. The trading arm of an investment bank can be grouped into two categories. The first category is client trading, and the second category is proprietary trading and principal investment. Client trading division help their clients buy and sell securities. Services provided include matching up buyers and sellers, adding liquidity through market making, providing financing and stock lending services to clients who trade on margins. Research reports may also be sold to clients. Client trading division often works in two business groups according to the type of securities traded. The first category includes equity products. The second category is FICC, which is short for fixed income, currency, and commodities. The next trading arm of an investment bank involves proprietary trading and principal investment. These investment activities will affect the own account of an investment bank. A client is not involved. The sole business purpose is to invest on behalf of the bank. Proprietary trading is similar to investment of a hedge fund. It is characterized with short-term investments in traditional securities, including stocks, bonds, currency, commodities, as well as derivatives. Principal investing is a type of long-term investment with a bank's own account. It provides financing to another party without involving a client's money. Examples include a bank's investment in private equity, loans, and real estate. Investment can be directly made. A bank may also make indirect investment through funds they raise and manage. Our last business division covered is asset management. The asset management division includes asset management and private wealth management. Asset management professionals offer investment products to clients. The products provided cover equity, FICC, and alternative investments. Revenues are paid as a percentage of assets under management, or AUM. Performance fees may also be charged based on product type. Private wealth management professionals act as advisors to investors, helping them decide how to invest their cash resources. In today's lecture, we have covered the business scope of an investment bank. In our next lecture, we will be reviewing the industry and regulation of this industry.